Welcome. In this lesson, we are going to examine the most common money laundering techniques used by criminals today. Understanding these methods is essential for any anti-financial crime professional. By the end of this lesson, you will be able to identify, describe, and distinguish each technique with confidence. We have 7 key techniques to cover. First, structuring, microstructuring, and smurfing, breaking transactions into smaller amounts to avoid detection thresholds. Second, money mule networks, using intermediaries, both witting and unwitting, to move illicit funds. Third, trade-based laundering, manipulating international trade documents to transfer value. Fourth, digital asset laundering, exploiting crypto, non-fungible tokens or NFTs, and decentralized finance or DeFi. Fifth, market-based money laundering, abusing capital markets instruments. Sixth, commodity-based money laundering, using high-value physical goods. And seventh, shell companies and front businesses, mixing illegal proceeds with legitimate revenue. Let's start with structuring, microstructuring, and smurfing, and the critical distinction between them. Structuring is when one person makes multiple sub-threshold deposits into one or more accounts to avoid triggering a reporting requirement. Smurfing scales this up. An organized network of couriers, called Smurfs, each deposit sub-threshold amounts across many accounts or institutions on behalf of a controller. Microstructuring is an evolution of classic structuring, where transactions are fragmented into very small amounts, sometimes as low as $1,000 to $3,000, spread across many days, branches, or payment platforms to defeat automated detection systems. Digital assets have created powerful new tools for launderers. Cryptocurrencies, NFTs, and decentralized finance platforms enable cross-border fund transfers with varying degrees of anonymity, making tracing extremely challenging. Launderers enhance that anonymity further by using mixing services and privacy-focused cryptocurrencies such as Monero and Zcash to obscure the origin and destination of funds. A third tactic is exploiting weak jurisdictions. Criminals deliberately use digital asset service providers in countries with lax anti-money laundering or AML and counter-financing of terrorism or CFT regulations to convert illicit digital assets into fiat currency. Money mule networks rely on intermediaries to move illicit funds and create distance between the criminal and the money. Witting mules knowingly participate. They are recruited through organized crime and are fully culpable under criminal law. Unwitting mules are deceived victims, lured through romance scams or fake job advertisements offering payment processor roles. They genuinely believe their activity is legitimate. Key red flags include a new account receiving a large inbound wire that is immediately forwarded, customer activity inconsistent with their stated occupation or income, and multiple unrelated third-party transfers with no clear business rationale. Trade-based money laundering, or TBML, exploits international trade transactions to move value across borders, and it is one of the most significant and least detected money laundering methods globally, according to FATF. The 3 classic manipulation techniques are over or under invoicing, which misrepresents the price of goods to transfer value between importer and exporter; multiple invoicing, which bills the same shipment more than once; and false description, which misrepresents the quality, quantity, or type of goods being shipped. Because TBML hides within the enormous volume of legitimate global trade, it is exceptionally difficult to detect without strong interagency cooperation. Commodity-based money laundering is closely related to trade-based laundering. It uses the buying, selling, pricing, shipment, or financing of physical commodities to disguise illicit funds. It is especially common in sectors dealing with metals, minerals, energy products, and agricultural goods. Assets are purchased with dirty money, then resold or smuggled to avoid scrutiny. High-value portable commodities, gold, diamonds, luxury watches, and fine art are particularly attractive because they transfer significant value anonymously and across borders with relative ease. Market-based money laundering, also called laundering through the markets, uses capital markets to make criminal proceeds appear legitimate. Financial instruments create complex transaction chains that effectively mask the origin of funds. Criminals exploit stocks, bonds, hedge funds, derivatives, and private equity investments to layer illicit money. A notable tactic is mirror trades, matching trades in different markets that move value across borders without an obvious money transfer. Rapid buying and selling of securities obscures the source of funds, and the use of intermediaries, nominee accounts, or complex trading structures hides beneficial ownership throughout the process. Three corporate structures are commonly misused in money laundering, and you must be able to distinguish them precisely. A shell company is a legal entity with little or no real business activity, assets, or employees. It exists primarily to hide the true owner or move funds. A shelf company is a pre-registered, dormant company kept ready until someone purchases and activates it. This can be entirely legitimate when a business needs to start quickly, but it can also be misused. A front company, by contrast, appears to be a normal operating business on the surface, but is actually used to conceal illicit activity such as money laundering, fraud, or sanctions evasion. Let's recap the 7 techniques we covered. Structuring, microstructuring, and smurfing all focus on breaking transactions below reporting thresholds. Know the distinctions between them. Money Mule networks use both complicit and deceived individuals as intermediaries. Trade-based laundering manipulates invoicing and shipment documents to move value across borders. Digital asset laundering exploits crypto, NFTs, and DeFi, an area of rapidly growing risk. Market-based laundering abuses capital markets instruments to layer funds. Commodity-based laundering uses high-value physical goods to store and transfer illicit wealth. And shell companies and front businesses mix illegal proceeds with legitimate revenue to achieve integration. As you study, always anchor each technique to the 3 stages of money laundering: placement, layering, and integration, and identify where each technique most commonly appears. For more study resources, visit camsprep.com.